Warren Buffett just stepped down with $382 billion in cash, the highest level in Berkshire Hathaway's history. While everyone's chasing AI stocks, the Oracle of Omaha is doing something he's never done before. And if history repeats itself, ignoring this warning could cost you dearly in 2026. Welcome back to the channel. If you're new here, I'm breaking down the most important market signals that everyday investors need to know. Today's topic is critical. Warren Buffett officially retired as Berkshire Hathaway's CEO on December 31, 2025, but his final actions as CEO are sending shockwaves through Wall Street. The legendary investor has been systematically selling stocks for 12 straight quarters and hoarding an unprecedented amount of cash. This isn't normal behavior from Buffett, and history tells us exactly what happens next. By the end of this video, you'll understand the 3 stocks to buy now that could protect your portfolio while everyone else panics. Buffett's warning signal: the record cash position. Here's what's happening. As of the third quarter of 2025, Berkshire Hathaway's cash and short-term treasury holdings reached $381.7 billion. Let me put that in perspective. That's more than the entire GDP of many countries. This is a 281% increase from the $100 billion they held just 2 years ago. But here's what makes this truly alarming. Buffett sold a net $184 billion worth of stocks over the past 12 consecutive quarters. He's been a net seller since the bull market began in late 2022. Even more telling, he cut his Apple position, once representing half of Berkshire's portfolio, by nearly 75%. The remaining Apple stake is still worth $60.7 billion. But the fact that he dramatically reduced his largest winner speaks volumes. The valuation warning. The S&P 500's cyclically adjusted price-to-earnings ratio, or CAPE ratio, closed 2025 at 40.7. According to data from economist Robert Shiller, this is the second highest valuation in market history. The only time it was higher: the dot-com bubble in 2000. When the CAPE ratio has exceeded 39 in the past, the S&P 500 declined by an average of 4% in the following year and 20% over 2 years. What this means for 2026 historical patterns: history doesn't repeat, but it rhymes. Every time Buffett has built massive cash positions, a market correction followed. Before the 2008 financial crisis, before the dot-com crash, he raised significant cash. He's not a market timer, he's a value investor who refuses to overpay. Currently, the S&P 500 trades at a forward P/E of approximately 22.5 times earnings. That's well above the historical average of 16. The Buffett indicator total market capitalization to GDP sits at 226%, far exceeding the 200% level that preceded the 2000 crash. Greg Abel, Buffett's successor, who officially took over on January 1, 2026, inherits this massive war chest. But the message is clear: Buffett positioned the company for a downturn, not a boom. President Trump's tariff policies, which raised average import taxes to 16.8%, the highest since 1935, add another layer of uncertainty. Goldman Sachs economists project this could slow GDP growth in 2026. 3 defensive stocks to buy now. So what should you do? Here are 3 defensive stocks to buy now that align with Buffett's philosophy of value and safety. Stock number 1, Procter & Gamble PG. Company overview. Procter & Gamble is a consumer staples giant with brands like Tide, Gillette, and Pampers, products people buy regardless of economic conditions. Why now? While tech stocks trade at 27 times forward earnings, P&G trades at approximately 21 times earnings, a significant discount. The stock is down 14% from recent highs, creating a rare buying opportunity. Consumer staples historically outperform during market downturns because demand remains steady. Financial metrics based on recent 2025 data. Market cap, approximately $345 billion. Forward P/E, 21x. Dividend yield, 2.5%. Operating margin, 24%. Debt to equity, 0.5 to. Growth catalysts. P&G continues raising prices to protect margins, while maintaining market share in essential categories. Their brand power creates pricing power. International expansion, particularly in emerging markets, provides growth even during U.S. slowdowns. Risk factors: private label competition is intensifying. Slowing consumer spending could pressure volumes. Currency headwinds from a strong dollar impact international revenue. Price target. Analysts project upside to $180, $185, representing 8 to 12% potential gains plus the dividend. Stock number 2, Berkshire Hathaway BRK, B Company Overview. Buffett's own company, a diversified conglomerate with insurance, railroad, utilities, and a $267 billion stock portfolio. Why now? You're essentially buying Buffett's curated portfolio at a reasonable valuation. The company generates $13.5 billion in quarterly operating earnings, up 34% year over year. With $382 billion in cash, earning 3.6% on Treasury bills, Berkshire is positioned to capitalize on any market correction. Financial metrics: Q3 2025 data, Class B shares, trading around $480, $500 operating earnings. $13.5 billion quarterly cash position, $381.7 billion book value per share, growing steadily. Growth catalysts under Greg Abel's leadership. Analysts predict Berkshire may initiate its first dividend since 1967 in 2026. The company could deploy cash for major acquisitions during a downturn, possible expansion into technology stocks at better valuations. Risk factors: leadership transition, uncertainty. Massive cash position creates opportunity cost if markets continue rising. Scale makes finding needle-moving acquisitions difficult. Price target. Fair value estimates range from $550 to $565 per Class B share, representing 15 to 18% upside. Stock number 3, RTX Corporation RTX. Company overview: defense contractor producing missile systems, aircraft components, and military technology, a true recession-resistant business with government backing. Why now? Defense spending globally is accelerating. RTX's backlog hit a record $251 billion. That's contracted revenue waiting to be executed. The company's Raytheon segment reported a book-to-bill ratio of 2.27 in Q3, meaning new orders were more than double shipments. Financial metrics: 2025 data, stock price, approximately $185. Revenue growth, 12% year-over-year. Backlog, $251 billion. Operating margin, improving due to scale forward. PE, 19x growth. Catalysts: NATO allies are increasing defense budgets. Recent $1.7 billion Patriot missile deal with Spain, U.S. Golden Dome Defense Initiative. Ukraine and Middle East conflicts are driving sustained demand. Risk factors: government budget uncertainties, production delays are possible, margins can compress on new programs. Price target: analyst consensus around $196, with bulls targeting $219, representing 6 to 18% upside from current levels. Here's the insider strategy: dollar cost averaging is your friend right now. Instead of going all in, build positions gradually over the next 3 to 6 months. Buffett himself didn't sell everything, he maintained positions but increased cash. Follow that playbook. Keep 20 to 30% cash for opportunities. Focus on companies with strong balance sheets, predictable earnings, and dividend growth. Avoid speculative plays and over-leveraged growth stocks trading at extreme valuations. Remember, all investments carry risk. Past performance doesn't guarantee future results. This is educational content, not financial advice. I am not a financial advisor. Always do your own research and consult with a licensed financial advisor before making investment decisions. Never invest money you can't afford to lose. Warren Buffett's warning is clear. Caution wins in expensive markets. These 3 defensive stocks to buy now: Procter & Gamble, Berkshire Hathaway, and RTX Corporation position you for protection and opportunity. Which stock are you watching? Drop your thoughts below. Smash that like button and subscribe for weekly market analysis that could transform your portfolio.